We're back on Morning Movers. Chipotle, one of the big names, reporting earnings after the close today. Analysts are projecting first quarter EPS of 28 cents a share on revenue of nearly $3 billion. Chipotle investors looking for some good news. Shares down more than 20% so far in 2025. Shares indicating higher in the pre-market, though. Time now for Options Corner. Joining us to take a deeper look at Chipotle is Rick Ducat, lead market technician. I feel like we know what we should have for lunch today already, Rick, but talk to us about the trends you're seeing on this chart for Chipotle.
Yes, a stock that has really underperformed not only its own sector, consumer discretionary, which is doing a bit better than the broader market, 7.8%, 4.2% for the consumer discretionary sector and the S&P respectively. Meanwhile, Chipotle all the way down here, minus 19.2% during the same past year period here. So a tough time for this particular stock. And we can see that the trend has been fairly consistent to the downside. We hit this high point here on December 12th. From there, we have fallen below our moving averages, yellow 21-day, orange 63-day, purple 252-day. Notice that the faster moving averages are below the slower ones, and they're continuing to diverge farther apart from each other, which suggests that the trend is not reversing. I'm not really seeing any signs that things are switching to an uptrend here. The only thing that stood out to me was a little bit of bullish divergence here. When we hit these low points. And even that, though, it's very common for momentum to calm down as you head into an event risk situation like earnings. So I'm not sure how much I would want to make of that. Now we can see as well that in terms of volume profile, the most notable volume node, the area of heavy trading, comes in right around 50, which is quite close to our yellow 21-day EMA and our trend line. So a breakout beyond 49.50 or so, that would probably be the area that the bulls would have their eye on. To the downside, for further support, our -2 standard deviation channel, pretty close to the bottom of our price channel as well. That comes in just below 43, so that could be a downside area to keep track of.
Okay, so that's the upside downside area to keep track of, especially when you take kind of recent perspective. What happens when you look at this on a 5-year chart?
Sure. If you were to pull out your view a little bit here, we can see that we have this very large kind of M-shaped price pattern here. So we had a push back to the upside. We failed to take out those old highs. Then we've seen a pretty notable decline. Right around here, this is our relative low point. We stayed above it near about 44. Big volume node here just below that as well, near 40, 41, 42. So that would be another important downside area.
Okay, that's an important downside area to keep on your radar. All right, thanks, Rick. That's the Duke of Data himself. Now, take us through an example trade. We've got Tom White, senior options contributor, co-host of Fast Market. So, Tom, how would you go about an example trade for Chipotle, especially given that we've got earnings in front of us?
Yeah, stock's popping here a little bit with the overall market today, but still down over 20% so far this year. So it's taken a beating here. But a lot of these stocks have in the fast casual, fast food restaurant chain. So with that in mind, stocks popping here a little bit. Implied volatility levels relatively elevated. The option market pricing in about a plus or minus 7% move either way in the shares, about $3.5 either way in the shares. So I looked at a strategy that's not a pure earnings play. I want to give myself a little bit of duration. If you think this thing is going to go higher, this is a type of strategy that takes advantage of it. But I'm giving myself a little bit of duration on this, just over 3 weeks until expiration. I went out to the May monthly cycle that expires on the 16th of May. We're going to buy that slightly in the money call. Stock's going to open up about $48.50 here. So we'll buy the 48 strike call and then against it because I want to offset some of my risks on this bullish trade. Setting up with that one standard deviation move of about 7%. I sold the 52 strike against it. So a bullish $4 wide call vertical on here. If the stock opens up about 48.5, you're going to probably pay about $1.75 debit on it. That's going to be your risk on this trade, $175 per spread, with the chance if the stock goes above 52 that you can make $225. So pretty decent risk reward setup. Now the break even on this, if you pay $1.75, is going to be $49.75 to the upside. That's only about 2.5% above the $48.50 level at this point. So you don't need a monster move. It's within that one standard deviation to get above that break even. But I think one of the key things in this type of strategy is even if the earnings come out bad, or maybe the stock goes up just a little bit, or it still remains where it is, you still have 23 days to expiration on this type of strategy for the stock to kind of recover and make some ground to the upside on this type of trade. Now, if you're bearish on this trade, don't do this type of strategy, right? This is a directionally biased trade, taking advantage of offsetting some costs on a bullish call vertical. If you're more bearish, maybe you buy a put vertical on the opposite side if you expect it to go lower. But this is a bullish example here, offsetting some of the risk and a pretty decent risk-reward setup going into earnings.
All right, that is another 2-for-1 that you gave us, Tom, initially with the directional bias to the bullish side, but giving the opposite perspective on that for Chipotle. We've got earnings coming up later today, shares indicating higher in the pre-market. Thank you, Tom.